My name is Vivian. I will be taking a session on technical analysis today. So we'll be looking at a couple of indicators that people use while trading. Of course, there are a lot of indicators that is available and a lot of technical tools that are available in the market for you to use, to make your investment or trading decision. So let's go right ahead and start with it. To start off with, let's understand what are the types of analysis that people do. So one is technical analysis, which we are going to be covering today. The other one, the primary one, usually is more on fundamental analysis. So just to give a very brief explanation on the difference between the both. Technical analysis and fundamental analysis are done by two sets of people, although both the analysis could be used by both investors and traders. Usually, anyone who's looking to invest in the market for a long period of time, let's say anywhere between 2 to 10 years or 2 to 5 years, they always look at the fundamental analysis. So, what does fundamental analysis consist of? For example, if you're looking Apple as a stock, you would like to do a fundamental analysis on what Apple is, Apple stock, how well the company has been established, how the management is, and how the financials for Apple has been in the past, how profitable they are. So you look at the financial statements to understand the strength of the company and the potential of the future earnings from that company. So all this comes under fundamental analysis. But when it comes to technical analysis, you mainly look at the price action of the particular stock. Let's say, for example, again, if you're looking at Apple, you would like to look at a technical viewpoint on Apple's price action. So you look at Apple prices on a daily basis. You can also look at price action on a 30-minute time frame all the way till a monthly time frame. So now, what technical analysts look at the prices to analyze is to identify good entry and exit points. So most suitable for a short-term trader, anyone who's trying to do a 30-minute or a shorter time frame trade to take advantage of the price action, they would do technical analysis, because fundamental analysis would not play a very major role for someone looking for a momentum or a very short term trade. Of course, however, fundamental for Apple as a company, the even a short term trader should know what is happening behind the company, but he would not look at a very long time frame on Apple. So he will always look at the technical analysis. Now, moving forward, I hope you understood the difference between technical analysis and fundamental analysis. Now, let's look at a couple of things before we jump into the technical tools for now. So, there are a couple of charts, chart reading, different types of charts. One is a line chart. I'm sure all of you all are familiar with line charts. Basically, the line charts are charted out on every, in this case, you're looking at a 10-minute time frame. So, every 10 minutes, whichever price the product is trading on, that would be represented on a line chart every 10-minute time frame. So if you're looking, let's say instead of a 10-minute time frame, if you're looking at a daily time frame, it will be on a daily basis. And if you're looking at it on a weekly time frame, it will be on a weekly basis. Now, that is a very simple version of the chart reading. Now, coming to the candlesticks, a lot of traders look at candlesticks to identify good opportunities. Now, candlesticks, again, very simple to understand. In this particular chart, you can see there is a body, and you can see the wick or the tail. If you would like to call it a wick, it looks like a candle's wick. Now, if you look at the body, this one is green, this one is red. So, what does the body represents? The body represents the open of the price and close price. So, in this case, let's take an example of the green candle over here. Let's say the market opened at $5, and then it went up as high as $10 but closed at 8. But after it opened, let's say it opened at 5, first initially it dropped down till 3, and then again came back to its open price and closed at 8. So wherever the open and the close, let's say I'm looking at a daily time frame, For the day, market opened at $5, it closed at $8. That creates the body. But while it was trading during the day, it also actually had gone up as high as $10 and as low as $2 on the lower end. So now the VIX always represents the high and the low, and the body represents the open and the close. Now, on a red candlesticks, it is completely vice versa. The price opened, let's say, for an example, at $8, but it went down as low as $2, but closed at $5. So again, it is the same thing. It represents the open and the high. Because it opened higher and closed lower, it becomes a red candlestick. And now, of course, the tail or the wick represents the high and low in the markets. So I hope all of you are clear with the candlestick pattern. Now, a lot of people, if you hear them speak, or if you look at a lot of technical analyst articles, you would hear them talk about a lot support and resistance. Now, the most basic form of support and resistance are where prices come to a similar price multiple times, and hence it becomes a support. Let me give you an example. Now, let's say if there is a stock that has been trading between 10 to $40, uh, let's say over a period of 1 year. Now we see the market go up from $10 to 25, and then you see the price come back to 15. A month later, you will see again the price goes back up to 28, 30, and then again it comes back towards 15. 2 3 months later, you will see the price go back to maybe this time 20 only, and then it comes back to 15. Now, if you can notice with the example that I gave you, there are multiple times it comes back to 15, and for whatever reason, 15 has become the support. So it becomes a psychological level. So now, anyone who's trying to take advantage of a short-term momentum trade, they will always be excited to buy whenever it comes to 15. Why? Technical analysis is based on price action, and the price action has showed them that every time it has been coming down to 15, there is always a price movement back upside towards 20 or $25. So this is an example of a support. Resistance would be again similar. Let's say every time the same particular stock goes up to $30, it comes back down to 20, 25, or again it goes back to $30. Again, couple of weeks later, it comes back down from 30 to, let's say, 15, and then a few months later, prices go back till 30, and then again. So when I'm giving you 30 or 15 as an example, it won't be exactly precisely on that specific number, but the point is every time it goes to that particular price range, it does not break above 30. So everyone who buys at a lower level, like let's say at 15, which is the support, they will always look to take their profits at 30, because again, historically looking at the technical analysis, there has been resistance at 30. Now, resistance and support is pretty much clearly defined on where the price action happens the most. Now, one more point that we can always remember is every time a resistance breaks, let's say in this example, the resistance was around 30, and every time now the resistance broke, that has the potential to become the future support. I will show you a couple of examples as well while we are going forward with the session. So far, if you all have any doubts, please feel free to write in the chat. So there's a saying that goes trade the bounce. So buy when the price falls towards the support. So every time it comes down to towards the support, you buy. Why do you buy? Because that those are the levels that all technical analysts and traders are looking to take advantage of. So you always buy when the price falls towards your support. Sell when the prices rise towards your resistance. So that is definitely after you buy, you book your profit or you take your profit once it goes towards your resistance. Trade the break. Now, trade the break, we will get back into that. I'll show you a couple of live examples on how you would trade a break. Let's just get familiar with the support and resistance. Now, let's look at how do you plot support and resistance. Like I told you, in this particular example, we are looking at S&P 500, one of the indices, one of the instruments that you can trade on a 5 minute chart. This is just a demonstration. I will show you on live chart as well. Now, if you look at this, each candlesticks over here represents a 5 minute time frame. So every 5 minutes there has been an open price, close price, high and low. Every time the price has opened lower and closed higher, it becomes a green candle, and vice versa. Every time the price opened higher and closed lower, it has become the green candle. The tails are the high and the low. Now, if you look at this particular example, the prices dropped and then you see a bounce back towards the similar price, in this case 14140. It drops back down again, you find resistance at 14140. Now anything is said to be a good support or a good resistance when minimum 3 times it comes back to the same level. So if it happens for the very first time, it is less likely to be a support or resistance because it still does not signify anything. But the third time happening, then it starts signifying that there is a good resistance at this spot. So anyone who would have bought at the lower prices, they would look to take their profit at these higher prices. Now, similarly, you can look at this particular example over here. We'll come to the trend lines as well. Similar concept of support resistance, but trend lines are more in terms of trend and not on a sideway movement that you can see over here. This again, you can see there is a good price action. Price comes down to a certain level, bounces up to a certain level, comes down to a certain level, bounces up to a certain level. Now, this is an ideal scenario for for you to keep entering and exiting if you get a channel like this. But very rarely you would find channels, and when you do, you still need to wait for minimum 3 points to touch before you start taking any investment or trading decision to take advantage of the price movement. Most of the time the markets are always trending or they're swinging on both directions, so you would see a downtrend market or an uptrend market. Now downtrend market again similar, markets are dropping and every time it's trying to go up, it is making a lower high. So hence there is a resistance not at the same price, but every time it goes up, the prices are coming lower. So you see it's a downtrend market. It tells you about the trend, and at the same time it tells you where the resistance on this particular instrument is. Let's look at this particular example where the trend is on the upper end. So every time the market has moved up, when it comes back down, so in this case first time, second time, third time, so now you have 3 times confirmation of the support. However, it is a trending support. So the fourth time is where you could take a buy and you get another opportunity here, and it goes on. Now in this case, how do you determine your resistance? You can also draw a line on the higher end, similar with the symmetrical angle of the support over here. You will find the resistance and that will be your profits. So uptrend makes higher lows. If you see, it goes up. When it comes back down, it does not come below this low, it makes a higher low. Again, it goes back. When it came back down, it did not make a lower low, it made a higher low. So these are known as higher lows. At the same time, downtrend makes lower highs. That means every time market tries to go up, it is not beating the previous high. It is in fact coming up, but not going as high as the previous one. It keeps dropping back down again. Sideways is ranging. If you see ranging, the market keeps ranging on the side angle. The market will always remain in a particular channel and it goes in a sideway movement. Now, this is a sideway trend, which is also known as consolidation. Now, this is a support resistance, support breakout level, just an example of how you can utilize your support resistance and trend lines into making a trading decision. I will explain to you how this particular trade would work in reality and try and show you a couple of live examples as well. Now in this case we are looking at silver gave a massive drop and it makes an uptrend over here. So technically, we are expecting the prices to move higher every time it comes low. Now, remember I said about trade the break. Now, this is where we are looking at trading the break. Now, in this case, every time it came to the support, you would buy. Every time it went back to the resistance, you would book your profit, and there would have been one more opportunity. But what happens when the support trend line breaks? When the support trend line breaks, you can expect the trend to continue going down, which was the primary trend. So the primary trend was down, then you see a consolidation, and then once the consolidation is done and it breaks below, the downtrend continues. So anyone who's doing short selling could take a sell after the break, keep a stop loss. Risk management is always a key, irrespective of how good the analysis is and how well your analysis have performed in the past. Even if you have a very good hit ratio, without risk management, is very difficult to manage, even if you have a good hit ratio. And most successful traders do very well and are successful because of their risk management, and their risk management tools in place before they take any investment or trading decision. And of course, now on the downside, you can exit. In this particular scenario, the length of this drop is the target what they're expecting in terms of when it starts continuing the downtrend. I will explain a couple of these scenarios even on a live chart when if we get some opportunities while I'm showing you the trades. This is a similar trade, but this is on a reversal. You see an uptrend, then you see a downward channel, basically the market taking a consolidation phase and then resuming its upside. So once it breaks the resistance, you can see the resistance here, you take a buy. Now this is trading on breaks. You're not trading in the range or at the support resistance, you're trading on once the range breaks. Once the range breaks, you enter, you keep your stop loss, which is the risk management, and you keep your take profit. In this case, again, there was a rally consolidation. Your take profit would be as big as the rally that had happened before the consolidation phase. This is another pattern that you would commonly see, which is known as head and shoulder. We'll not get too much into it, but again, pretty much the same idea. You can see market moved up, came down, took support, moved down, took support, moved up, and then again came to take support. But in this case, it broke down. Again, we are looking at trading the break. After it breaks, you can expect it to drop all the way as big as this particular high over here. This is known as head and shoulder pattern. We'll get into it while I'm doing a couple of live examples as well. Now, coming to the technical tools. Now, we have understood a couple of things to just recap. One is line chart, which is very basic representation of the price movement. Next, we looked at candlestick patterns. So, candlestick patterns, we understood how the body is formed, what body represents, and what the tail or the wick represents on the candles. And then we have looked at support and resistance. Now let's look at a couple of technical indicators. While we are taking a trade or investment decision, you need, apart from your support and resistance, your technical tools that will help you. One is to identify entries and exits. Second, to identify opportunities where you can maximize your profit and reduce your losses. And main thing is how to use these technical tools to avoid making mistakes and to avoid incurring big losses by doing good risk management. So first tool I would recommend would be the average true range. Now average true range, to give you a very simple example of what an average true range is. Average true range tells you how many dollars a specific instrument moves. For example, let's say if you're looking at gold, and I'm looking at gold on a daily time frame. So you can look at any instrument on any time frame. Usually, people who look at a weekly or a monthly move, they tend to look at a daily candlestick pattern rather than looking at a 5 minute or 10 minute chart. pattern sticks. But let's say investor who's trying to look for a longer period, he might be looking at a weekly time frame. Now, in this example, I will always look at, or I will talk about a daily time frame. Now, if you're looking at a daily time frame on gold, we want to, what ATR, which is the average true range, represents is that it tells us how many dollars can gold move in a single day. Now, this is based on the average movement gold has been doing for the last couple of days or last couple of weeks. So, average true range tells us how many dollars can gold move in a single day. Now, please note that average true range does not tell you how which direction can gold move. It only shows you how many dollars it could move. Now, let's take an example. So if you've not used a platform before, we have multiple platforms. This is one of them where you can. I'm looking at S&P 500. This is a monthly time frame, so we are looking at a monthly time frame for S&P. That means each candlesticks represents 1 month move. Now, if you come down there is technicals. We click on technicals. We go to studies. Once we go to studies, we find ATR. Do not worry about finding these tools. We will be able to help you. You can get in touch with the representative from Century so that they will be able to help you and guide you, get the demo access. Or if you already have a live account, you can get in touch with your relationship manager for them to assist you further. Let's just focus on how ATR works for now. So once we click on ATR, now the ATR is drawn. You can see because I'm looking at the monthly time frame, it shows me data all the way from 1998 till date. There's not as of current today's market price, but it shows you all the way till 2023. So each of these candles, like I mentioned, represents a monthly move because we are looking at a monthly time frame. Now let's look at what has been happening like from 2003 to 2008. If you notice, SPX, the maximum SPX at that point of time moved was roughly about $100. That means in a month we could expect SPX to move about $100. At that point of time, SPX was trading roughly around $1,000, so $100 move was roughly a 10% move on a monthly basis. Now, if you can notice, you see over here, SPX average movement was just $100 a month, but it does not tell you which direction. So please keep in mind that the average true range does not indicate direction in the market. It just tells you every month how many dollars can you expect SPX to move. As of today, SPX is moving about $340, and SPX is trading roughly around $3,900. So now you know if you have to buy SPX and you're looking at a monthly time frame and you identify good levels to buy SPX. Since you're looking at a monthly time frame, people would look to invest for 6 to 12 months or even go up to 5 years. So in this case, let's say anyone who looks to buy and hold, they can expect SPX to perform in their favor by $340, or they could also expect SPX to go against them by $340 so they can plan their investment better. So if they buy at a lower price or at a good support, they know the probability of them making a return on a monthly basis at least is going to be about $340. But if they wait for a couple of months, it could continue climbing and they could end up making double or triple this. But because they know $340 is the maximum move, and if they get the maximum move, let's say they bought it today and it moved $340 in 3 days. Now, that is a good return for someone who was looking to make $340 in a single month. They got the same return in probably 3 to 4 days. So you would take an action of probably taking out some profits from that particular trade. So that's how your ATR works. Now, we'll come back how to combine ATR with our support and resistance. Now let's look at relative strength index. Now this is our alternative technical tool that you can use along with the ATR. Like I mentioned to you, there are a lot of technical indicators. I'm just covering a couple of them for today, and we will put this on the live charts or the charts which have live prices right now, and identify trading opportunities and how you would make a decision on them. Now, relative strength index basically is an oscillator. What it means is the RSI is a momentum indicator. It shows you oversold and overbought region. So what it means is whenever the market has been dropping, people would like to know at what level or what prices can this particular price start becoming oversold. Meaning, it is oversold, so buyers would try and come back in to buy because you're getting it at a much cheaper price. For example, let's say you're buying a product and the product has a 2% discount. You're not very attracted towards a 2% discount. But let's say a few days go by, now the same product is at a 5% discount. You would be kind of interested in it. But let's say moving forward couple of months later, the same product now is at a 40% discount. Now you would really want to get into it because you're getting a steep discount. And of course, just like you and me, there will be millions of people who want the same product, and now they, since they're going to get it at 40% discount, they would want to come and rush in and buy. Now what happens when everyone wants to buy? The demand goes up. So what happens when the demand goes up? Now what was 40% lower, because the demand has picked up, the seller or the particular product will start selling off. That means there'll be limited products to be sold. So what happens? The price of that particular instrument goes up. So pretty much what I'm trying to tell you, it's all about demand and supply. So every time the prices are cheaper, now if you're looking at Amazon as a stock, if you're looking at Apple as a stock, now we know that Apple, Amazon, these are mega companies which has been performing quite well for the last couple of years or a decade. Now, would I buy Apple at today's price? I would have to look into it because I know fundamentally Apple is a strong company. But would I buy it today? But let's say Apple's price has dropped by 30%. Would I buy it? Of course, a lot of investors would be interested because now instead of paying a very high price for Apple, for each stock of Apple, they're getting a 30% discount. And that is where RSI now comes and helps us to give you another indication of where an oversold region could be. Let me go into the charts. Again, example of a monthly time frame, SPX. You go to technicals, SPX, technicals, studies. Now, I'm looking at a weekly, sorry, not a monthly. We click on RSI. Now, this is RSI. Now, RSI, like I told you, it is known as the relative strength index. So it is an oscillator, meaning it keeps oscillating between two regions. Okay, the highest it can go is 100%, and the lowest it can go is 0%. Now, the basic method of anyone who use RSI looks at overbought region and oversold region. Most traders look at 30% and 70% as the overbought or oversold region. Now, in this case, 30%, anything that goes below 30% is an area where you would consider buying, and every time it goes above 70% is an area where you would consider selling. If you're short selling, yes. If you're already bought, you would probably take a profit because it's an overbought scenario where the markets can start dropping back down again. At an oversold region, you would see the market coming down at a discount. One is you're getting a discounted price. At the same time, your RSI is giving you a signal, or it is indicating that the market is potentially oversold and market could climb back up. Now, of course, using RSI alone is not going to make any sense. There are positives to it, there are also negatives to it. RSI could remain oversold for a long period of time and the markets continue dropping. So it is always wise to get two to three good confirmations and then make our investment decision. So now these are a few tools that we were looking to cover for today. Of course, I will try and show you a couple of moving averages on the live chart as well. Before I move on to the live chart, I would just give everyone a 2 to 3 minute break. If you'll have any queries, if you have any questions, please feel free to write it in the chat right now. We'll just resume our session in the next 2 minutes again. Thank you. Hi, welcome all. I hope you can hear me again now and you can see my screen. Uh, I would appreciate if you can just drop in a message in the chat again if you can hear me and if you can see the screen. If not, I would not know that if you're able to hear me. I'll just wait for a minute. Once I get your response, I will go ahead and continue. All right. So let's get back now. We are looking at the platform with the live products. Let's look at Apple since we were talking about Apple. I hope you can hear, you can see me over here and see the Apple prices. All right, now Apple, I'm looking at a daily time frame. Now let's make it a little more interactive. While I'm doing this, you can give me some suggestions or you can ask me questions as well. Of course, on the chat. If not, it just becomes too complex for everyone to speak at the same time. So what I'll do is while I'm doing this, you can ask me questions or you can ask me to change the time frame over here. If you want to see how it looks on a 10-minute time frame or if you want to look at how it looks on a monthly time frame, I will do that for you as well. Now let's put all the tools that we learned for now. So I've searched for Apple. I'm looking at a monthly time frame for now. I'm going to go to technicals, go to studies, select my ATR first. Just a refresher on ATR. ATR tells me how many dollars a specific instrument can move. Now, in this case, the instrument is Apple and the time frame is 1 month. So I click on ATR. Now, ATR shows me Apple moves about $20 as of today. That means in a month time frame, I can expect Apple to move $20 maximum. Not that it cannot move more than $20 or it has to move minimum $20. There is no limit as such. But what it's trying to tell me is as of today or as of this month, the max we can expect it to move is about $20. The same Apple, let's say in 2021, the average movement, monthly movement was just roughly around $13. If you can see on the right hand side, if I go back even way earlier, let's say between 2015 and all the way till 2018 and 19. Apple in a month would move maximum to six, three, four, $5, $5 max. So we are getting pretty much a $20 move as of this month, as of now. In the recent months, like the momentum has picked up all the way from December 2021. So as of today, we can expect a $20 move. Now coming to our next indicator is the RSI. So you will find RSI here. So I'm going to click on RSI. Remember what I told about RSI, our overbought and oversold region. Now on a monthly time frame, Apple has rarely been in the oversold region. Now, there are few conditions that you can always tweak according to the instrument and according to your trading style and your investment style. So, ATR, now I'm looking at an ATR with a 14 time period length. That means it takes a 14-month back period to understand and calculate how many dollars it's been moving for the last 14 months. Now I can always change that to last 5 months. So basically now it has changed a little bit, not very drastically. Let's say if I make it on an average of 25 months. Why I'm saying month is because I'm looking at a monthly time frame. So now, if I look at 25 months, it has a more smoother up curve because every 25 candlesticks behind is the average it's taking for us to know how many dollars it can move. Let's go back to the standard. So these are standard RSI again on a 10 period. Now, if I change it to a time 5 period, now you see you get a lot of overbought and oversold region as well. Again, like I told you, these technical tools are always there to help you identify trades, but you also need to understand each of the technical tool well, and backtest as much as possible. So you have backtesting tools where you could always put in your formula every time RSI was at oversold region, and if you had to buy, what could have been the potential result, and every time it was at the overbought region, if you had to sell, what would have been the potential result of it. Now I also mentioned a couple of drawdowns on RSI. RSI could be at a overbought region and still continue going up, so it is not necessarily every time it is at a overbought region uh, the market has to drop. Now how do you avoid such scenarios is by backtesting. Now let's look at the same tools on a smaller time frame. Let's look at a 30-minute time frame and see how the price action has been going on so far. Now let's just take on a 30-minute time frame. Now first we understand what we understand is on a 30-minute time frame there's not major movement on Apple. You can hardly get 79 cents movement. So let's look at a little bigger time frame. Let's say a 4 hour time frame. Okay, on a 4 hour time frame, RSI looks to be much more decent. You can expect a $2.3 move on a single day. Sorry, on every 4 hours. We are not looking at daily, we are looking at every 4 hours. Now let's look at the overbought and oversold region for at least the last couple of swings. Um, Here we go. There was a oversold area, there was a overbought area, there was a oversold area here, and we have a overbought and again a overbought region. Now, one tool which is the RSI tells us the markets are oversold. We can expect the markets to go back up. Okay, while we expect the market to go back up, remember the other tools that we utilize to identify support and resistance. Now let's see if there are support and resistance over here. Now I can see markets coming down, so there is trend downwards, and every time it comes, so you can identify a channel over here. Let me extend this to the right. Now, in this case, you see a channel. There's a beautiful pattern that is working in place. So now remember the breakout trade. So every time you get a breakout trade, you can take a trade. Okay. At the same time, every time it came down to touch the support line over here, you can always look at RSI at that point in time. So in this case, RSI was oversold. So, and it is giving you a support on your trend line. You take a buy, and once it touches your resistance line, you can potentially book your profit. Now, the second time it came down was around this region, and you see RSI again is oversold. So now you have two confirmations: one support, and RSI is at oversold. So there is more chances of this going back up, and you take a buy. Now you can book your profit at the resistance. Now, if the resistance breaks, you can buy back again into the market, because now this becomes the next support, and you can hold on till it goes to the oversold region to sell it. Now, how do you use ATR in the similar scenario? Let me give you an example. We'll take one live trade also. Hopefully, we get to see the momentum now, or we'll try and do it on a 5 minute time frame so we get a result also quicker. So let's say we wanted to buy Apple at the oversold region. So we are taking advantage of. Let me just close the others. Yeah. So we are taking ATR says $2.3 more. Perfect. At this point of time, ATR was $1.5 movement. Okay, no worries. So we are trying to take advantage of buying Apple here, and we got one confirmation, which is the trend line support. Second confirmation, which is my RSI oversold. Now, in the case where I do not know how many dollars of risk should I take, or how many dollars of take profit should I take, we can always measure it by placing stop losses and take profit. Now I'm going to keep a stop loss of, we are going to be buying at 144.5, which is the blue line here. Okay. And I'm going to take a stop loss of, let's say if it comes back down to 143, that is $1.5 lower. But why would I choose $1.5 lower? Did I randomly come up with that number? I did not. I look at my ATR. So what is my ATR saying? My ATR says every 4 hours I can expect Apple to move about $1.4. Now I can see Apple in the last couple of 4 hours, so 4 hours, 8 hours, 12 hours, has already come down by 1.5, 1.5, $1.5 on an average. Now I'm going to keep my stop loss again $1.5 lower, so just in case the trend line breaks and it continues going down, I want to exit the trade. So I have an exit plan even before I look at the profits. So this is one effective way to try and get your trades good instead of taking any impulsive or emotional based decision. You always have the perfect logic, or the perfect not the perfect, or you get the best signal possible to take advantage of the opportunity. Now, of course, nothing can be 100% perfect or sure shot as well, and hence the risk management. So $1.5, I hope you understood the stop loss, $1.5. Now, take profit, there are two things that I can do on take profit. I know once it goes back to the resistance on the upside, okay, I can exit. That is giving me a profit of $3.5, which is still not bad. I'm risking $1.5 to make $3.5 profit. One is to three, sorry, one is to two. I'm risking 1.5 to make $3, so which is risk reward wise 1 is to 2. Here could be my one potential take profit. But now, if I'm purely looking at RSI and I expect the market to go back even higher. So this would be my next resistance. So if you notice over here, this is actually the bigger region where prices are jumping up till before it starts dropping back down again. So I can always expect a higher profit and keep my target even higher. Now, in this case, I'm risking about $1.5, but I'm making a huge profit, almost $10, almost $11 in my favor. But is this always possible? No. So, the most sensible thing to do is you can have two parts. Once it comes here, if I had bought, let's say, uh, 150 shares, or let's say I had bought 100 shares of Apple, when Apple comes all the way till here, I'm making $375. I might close 50 shares and hold on to the rest of the 50 shares, which will continue making profit for me. And if it goes to my next resistance, I still make about $500 in the remaining shares that I had. If I continued holding all my 100 shares, I would make about $1,100 on this particular trade. My risk is $150. My profit is about $1,100. So combination of multiple technical indicators, having at least two to three indicators that is giving you double confirmation, would be an ideal scenario where you can take advantage of the opportunity. But please keep in mind your risk has to be managed, and wherever you're keeping your stop loss has to be very logical, because I cannot keep a stop loss very far away because I'm scared where my stop loss could trigger. In that case, what happens is now my risk is $500 to make a profit of $1,000, which is still not bad. But if I was considering taking a profit here at this resistance, now I'm risking $600, but I'm willing to make only $300. In this case, what happens is if two or three such trades go wrong in your favor, your loss magnifies. Whereas every time you make profit, you're making minimal profits. So if I take a stop loss of three trades on such magnitude, I need to take at least 6 to 9 profitable trades just to cover these losses. So we do not want such scenarios. So our stop loss has to be needs to make sense to in the area that you want to keep. Second second thing that you need to avoid is keeping stop loss too close as well. Keeping it too close could always first trigger your stop loss and then go against you. Now, of course, this happened in the past. Easy to explain. Let's try and find a good opportunity right now if we get one. Let's look at Nasdaq. Nasdaq moves quite a lot, so I hope we get a good trade. Oh wow, Nasdaq. Sorry, this is not Nasdaq. This is natural gas. I was wondering how Nasdaq came down so low. All right, perfect. Now we have Nasdaq. I'm looking at a daily time frame. Of course, daily is going to take a lot of time. Let's look at a 5 minute time frame. Do not trade on a 5 minute chart. Only once you're used to it and you understand how markets work, then you could do always a smaller time frame. If you're looking at intraday, it's always advisable to see a time frame of 30 minutes, 1 hour, and 4 hours chart. I'm showing a 5 minute chart just to show what we can identify in this using RSI and DATR. Okay, now let's look at 5 minutes. I can see market has been pretty much, you know, like you identify by looking at the current market scenario, these prices over here has been quite strong in terms of support. Technically, it's been trading in this range. It came back, now it retested, bounced back up. Again, it has tested, bounced back up. So that is one support. Now you have 3 points: one, two, three, four, fifth, sixth point. Okay, now you have 6 points of connection. Let me do this fast before the trade goes away. RSI is showing me oversold at this, but it's not showing me oversold here. So I would not take this trade because I am not getting a oversold position. And in the meanwhile, let's assume it was a oversold position and I had to take this trade. Uh, let's see how I would keep my stop loss and take profit. Stop loss, one easy way to keep is below your supports, and take profit. Will come back to that. Now, if you are not comfortable keeping a stop loss below your supports because you do not know how far or close to keep, the most simplest way is, let's say I'm going to be buying Nasdaq at 11,580. Now, what does my ATR say? It says it can move about $20. So I need to keep $20 away. So I'm going to be buying at 12,890, and I'm going to keep a stop loss at 12,570. Okay. At the same time, on the upside, let's look at resistance. Resistance would be the upper channel. Okay, so there's a good upper channel here. So these are my resistance. Ideally, this is where I would exit. So you're entering at 5,000, sorry, 12,588, and you would be exiting at 12,626. Now, let's say if you do a 10 unit trade on this, you're risking about $200 to make about $400 roughly, which is still not a bad risk reward ratio. If you bought it like on the trend line, it would be about 200 to make about $400 profit. So here's an example, but of course, I would not have taken this trade because RSI has not given me a confirmation of oversold. So technically, it could break this trend line this time and continue dropping. And then I would do a breakout trade. Once your trend line breaks, I would do a breakout trade, meaning I would sell, short sell the market, and probably expect it to drop as low as here. Reason being the continuation of the drop. So it dropped, right? Now, if you look at this particular example that I had shown you in the charts, I'm just going to close the RSI and ATR. It dropped, consolidation and continuation of the drop would be roughly about 120 points. Um, yeah, somewhere here. So the length of this drop could be the continuation once the support breaks. So now that is how you trade on support and resistance. But again, please do not purely trade specifically on support and resistance. Have a combination of your RSI, and RSI is not the only indicator. We have multiple indicators. You can use moving averages. I will show you a couple of moving averages that you can use over here. Renew overlays. SMA is simple moving average. Now, what does a simple moving average show you? Pretty much the same thing. On a 5 minute time frame, it is showing me for the last 50 candlesticks what is the average price. Now, if you see, a lot of people use 200-day moving average because the bigger the data, the more good support and resistance are. Now, if you just use a simple moving average of 200-day on a 5 minute chart, it shows you that this particular 200-day moving average was a very good resistance earlier, but now has become a very good support. That means the market can continue bouncing up as long as it trades above 200-day moving average. But if it breaks below the 200-day moving average, you see the behavior below it. It can keep trading below the moving average. Uh, Let me take a daily time frame. Now you would get a much better understanding because I'm looking at a daily chart. If you're looking at a weekly chart, now this is a weekly chart. You will see all the way from 2000 two onwards. Of course, now you would not look at a weekly chart if you're trying to take a short-term trade, but if you're looking at a long-term trading long-term investment opportunities, you would rather wait to buy around this region because historically it shows this was March 2020 where it took support around these levels. Again, you see in 2019 similar. area. It came close by. It did not touch the moving average, but 200-day moving average gives you a much more solid support in terms of decision making. Um, Final thing to keep in mind is tomorrow is a very big day for US. Federal rate interest rate are expected to be increased by 25 basis points as per the market expectation, but then we will need to see what Powell is going to come up with for tomorrow. After the banks started collapsing last week, they could be a little more cautious. They could just do 25 basis points and stop for the remaining months from increasing it further, or they could also reduce it. Oh, sorry, they could not increase it by 25 basis points, so which could again give some relief to the banks. Now, interest rates being high has been affecting a lot of companies' profitability, especially the technology companies. Bankings were under pressure because a lot of banks were holding long dated bonds. So every time the interest rate goes up, the bond prices drop. So their capital loss on their bond holdings were very huge, and that is what happened to Silicon Valley Bank. It could spread through a lot of other banks as well if it is not controlled properly, and hence the interest rate tomorrow could be a very big market mover, because if they raise the interest rate, bond prices are going to be under pressure. If they do not raise the interest rate, the bond prices could rally up, which would give a lot of relief to the banks. But however, interest rates were being raised to control inflation. Now we have two things that the Fed needs to consider before taking a decision for tomorrow. So tomorrow is going to be a very exciting and eventful day. So be tuned in the market. The interest rate decision is at 10 p.m. Dubai time, and 10:30 is the press conference. And between tomorrow US market opening till close, you could expect the stocks to move. You can expect dollar to move. You can expect goal to move. You can probably request for a demo and try taking advantage of these market movements. But our advice would be, when there are events, it's always best to stay on the sidelines, especially if you're doing short term trading. Better not to jump into the markets or get into the markets because of the volatility that could impact the markets. However, it would be interesting to see how all of these indicators play out during a volatile market. So you can always watch, put the indicators on your platform and watch how Nasdaq behaves at 10 o'clock in the night. Actually, you can start looking at it from 5:30 to 10 in the night. You would see a bigger move at 10 o'clock. You can watch a 5 minute time frame. So basically, a 5 minute time frame would give you every 5 minute how many dollars it's been moving, or even a 30 minute or 1 hour chart is also good enough for you to see the volatility that is going to come tomorrow. That one is on Nasdaq, the other one is on gold. Gold has been moving quite a bit. Again, gold is a safe haven asset. Every time there is uncertainty in the market, you see gold prices shooting up drastically. At this point in time, gold prices have started dropping back down on expectations of Fed not going to be very strong towards increasing their interest rates. But we will not know until tomorrow. So this is gold movement. Again, you can watch for last couple of days. It has rallied. Yesterday it came down. Today it has come down further. So gold is another instrument that you can watch out for tomorrow for the interest rate. Thank you all for the patience. I hope this session was useful for you. Please do write in the comments. Please give me your feedback. If you have any queries, if you have any concerns, if you want me to cover any topics, and your feedback is very valuable to me as well, so that I can improve myself to uh, give you a better seminar to help me guide you all better. So your feedback is really appreciated, and I would love to hear from you. Thank you all again, and hope to see you all in the next sessions or in our office sometime soon. Thank you. Good evening.